Welcome to The Deep Dive, the show that takes a stack of sources and really distills the most important nuggets of knowledge or insight.
Is that right?
Today, we're doing a real deep dive into the second quarter 2025 earnings conference call from Elevance Health. We've gone through the full transcript, all the notes, financial releases, everything to extract exactly what you need to know about their performance and, importantly, their revised outlook.
Yeah, this isn't just, a quick summary. We're aiming for a strategic breakdown.
Right, for you, the discerning investor, to quickly grasp the crucial takeaways.
Absolutely. Our mission today is to cut through all the noise, the corporate speak, and get straight to the core of Elevance Health's Q2.
Okay.
We'll be highlighting the key financial data, what management's really saying, their insights, and where the company seems to be headed strategically.
And focusing on the why behind the revised guidance.
Exactly. The drivers behind that revision, how they're tackling these industry-wide pressures, and ultimately what this all means for the broader healthcare sector and, importantly, for you.
Okay, let's rip off the Band-Aid then. What was the absolute biggest headline from Q2? The thing investors really need to grasp about Elevance Health right now.
Well, the headline numbers themselves were, a bit of a mixed bag. GAAP diluted earnings per share came in at $7.72. Adjusted diluted EPS was $8.84.
Okay.
But the really significant news, the one that just jumped off the page, was the revised full year 2025 adjusted EPS guidance.
Wow, right.
It's now set at approximately $30. And look, this isn't just a minor tweak. It signals some pretty significant turbulence, some fundamental shifts in their operating environment.
So that revised guidance is a major, well, maybe not red flag, but definitely a yellow one, points to deeper issues. What about membership and the revenue picture?
Yeah, so medical membership saw a sequential decrease, about 200,000 members down, landing at 45.6 million.
And why was that?
Primarily due to Medicaid redeterminations, people rolling off, and also lower ACA effectuation rates.
Effectuation rates. Just remind us quickly.
Right. That's basically the percentage of people who sign up for an ACA plan who actually follow through and pay that first premium. So people enrolling, but maybe not completing the process.
Got it. So a drop there. But revenue?
Revenue was actually strong. Operating revenue hit $49.44 billion. That's up 14% year over year.
Yeah, that's pretty good. What drove that?
Largely higher premium yields and also recent acquisitions they've made in home health and specialty pharmacy kipping in.
But there's always a but, isn't there?
There usually is. The consolidated benefit expense ratio, it increased by 260 basis points year over year, up to 88.9%.
Oof. So nearly 89 cents of every premium dollar going out for medical costs.
Exactly. That's a significant squeeze on their profit margins compared to last year, a direct hit to the bottom line.
So, okay, surface level. Mixed bag, strong revenue, but shrinking membership and squeezed margins. And that revised guidance just looming over it all. What exactly is driving this reset? Why the lower forecast?
Management was pretty clear on this. They pointed squarely at industry-wide elevated medical cost trends.
Industry-wide, not just Elevance.
Correct. Particularly bad in the Affordable Care Act market, the ACA market, and also a slower than anticipated deceleration in Medicaid cost trends. They didn't see the slowdown they were hoping for.
Okay.
And they explicitly stated, this is important, that this decision, this guidance reset, it's anchored in the view that these elevated trends will persist. They're not banking on some quick near-term recovery.
That's a crucial point, this idea that the trends will persist. What specific indicators are they seeing that gives them such conviction this isn't just a short-term blip? Let's dig into the ACA market specifically. The call highlighted three main factors hitting that book of business. What were they?
Right. Well, the biggest factor, they said it accounts for about 70% of the total impact. It's a significant rise in risk pool, acuity, and morbidity.
Okay, break that down. Acuity, morbidity rising.
Think of it this way. Healthier members seem to be leaving the market, maybe going back to employer coverage or other options. At the same time, you have higher acuity members, sicker members, coming in from Medicaid after those redeterminations.
So the overall pool of ACA members is just getting sicker on average.
That's the picture they painted, yes. That's the bulk of the issue.
And the other 30%.
That stems from two utilization-related factors. First, just higher utilization across several cost categories.
Like what?
They specifically called out ER visits, emergency room visits, behavioral health services, and also certain prescription drugs and specialty pharmacy.
ER visits. It's usually a big cost driver.
Huge. And they noted something quite stark. ACA members are using the ER at nearly 2 times the level of commercial group members.
Wow. Twice the rate.
Yeah. That fact isn't just a statistic, it really exposes a critical underlying challenge. Either these members are sicker, or maybe they have less access to primary or preventative care, so they end up in the most expensive setting.
So it's not just higher costs, it's a structural trend they're fighting.
It seems like it. It's something companies like Elevance are now having to confront, very aggressively.
Okay, that was the first utilization factor. What was the second?
The other factor is a subset of providers. They said these providers are using more aggressive coding tactics and inappropriately leveraging the independent dispute resolution process, the IDR process.
Right, the IDR process.
Yeah.
That was meant to handle billing disputes, right? Especially out-of-network stuff.
Exactly. But it seems some providers are exploiting it to demand significantly inflated payments, which, ultimately raises costs for everyone, the whole system, without necessarily improving patient care.
So gaming the system, basically.
That's the implication. And it's crucial to understand management views this as a market-wide morbidity shift plus these utilization issues, not an Elevance-specific pricing problem or a risk adjustment miscalculation on their part.
So they think their risk adjustment forecasts are still okay.
Yeah, they said their expectation for risk adjustment for the current year remains unchanged because their book is basically shifting in line with the broader market trends.
Okay. And what does all this mean for the actual ACA margins going forward?
The bottom line there is the operating margin on their individual ACA business is expected to decline year over year, pretty steeply actually, in the high single-digit percentage range.
High single digits. Okay, that's significant. So ACA clearly a major pressure point. Let's pivot to Medicaid. It sounds like the cost deceleration there was slower than they hoped. Why is that segment proving more stubborn?
You're right. The cost trend did decelerate, just not as fast as they modeled. More modest. They're seeing higher acuity in Medicaid, too.
Same reasons, redeterminations.
Largely, yeah.
Sure.
Ongoing disenrollment of healthier members leaving a sicker pool behind, plus an overall increase in utilization from those remaining members. And while the rate updates they got from states for the July cohort were kind of in line with initial assumptions, they actually lagged the current trend levels. The rates haven't caught up to how much costs are actually rising right now.
So the reimbursement isn't keeping pace with the actual cost increases.
Precisely, which means they're expecting a more prolonged Medicaid margin recovery period. Margins are still expected to improve year over year in the back half and stay positive for the full year, but they'll be below their long-term targets.
Were the states receptive when Elevance raised these concerns? Did they acknowledge the rising acuity?
Management characterized the discussions as constructive, but, the data needs to catch up. The states need to see the verified data showing the changed acuity before they adjust rates significantly. So Elevance expects a return to normalization, but it might take a couple of rate cycles.
And looking forward for Medicaid in 2025, what's driving the cost trend? Still acuity.
It's shifting a bit. For the full year 2025, they expect Medicaid cost trend to be driven about 1/3 by acuity and 2/3 by utilization and coding.
Interesting. So utilization becoming a bigger factor than last year.
Yeah, that's a shift from 2024, where acuity was the larger driver.
Okay, shifting gears again. Medicare Advantage. How did that segment perform amidst all this?
MA cost trends, they said, remained elevated, but importantly, they were in line with their expectations, consistent with prior quarters.
So no big surprises there, which is good news, relatively speaking.
Exactly. Stable margins are targeted for the year in MA. And looking ahead to 2026 bids, they're taking a, quote, disciplined approach, prioritizing plan offerings that deliver strong retention and sustainable long-term value. They're focusing on HMOs and DSNPs.
DSNPs being the dual eligible special needs plans for people on both Medicare and Medicaid.
Correct. And they're really, as they put it, leaning into margin normalization, trying to get those profit margins back to more typical sustainable levels for these plans.
Okay. And beyond those government programs, what's the picture in their commercial business, the employer-sponsored plans and such?
Well, outside of the ACA individual market issues, the large group commercial margins actually showed strong, consistent performance.
That's a positive sign.
It is. Group medical trend remains elevated, but it's in line with their pricing expectations. They're seeing similar cost pressures, though ER visits, physician-delivered behavioral health, specialty pharmacy, it's hitting everywhere.
But it sounds like they priced for it better in the large group segment.
Seems that way. The overall commercial margins, combining group and individual ACA, are expected to see a slight decline this year, mainly because that ACA business performance is dragging down the average.
Right.
But they did note the market is hardening, and they're seeing strong retention and sales in their fully insured products. So some underlying strength there.
Okay, so given all these, frankly, quite significant pressures across the board, what concrete actions are Elevance Health taking? What are they doing to try and regain stability and control?
Yeah, they stressed they are very focused on execution, managing costs, making targeted investments, reinforcing their operational foundation.
Like what specifically?
Key initiatives include streamlining prior authorization processes. They said over half of their electronic requests are now processed in real time.
That's a big deal for patients and providers.
Huge. They're also leveraging AI-enabled tools, things called Health OS and Intelligent Clinical Assist, to streamline clinical workflows and speed up routine approvals.
Using tech to fight back.
Absolutely. And using advanced analytics to identify fraud, waste, and abuse. And taking aggressive action against, quote, aberrant billing practices.
Which brings us back to that IDR issue.
Exactly. They mentioned they've actually filed a legal suit against misuse of the IDR process. Remember that provider asking for 21 times billed charges?
Yeah, that was staggering. That lawsuit sends a pretty strong message, I imagine.
You'd think so. It highlights just how much is at stake in this fight against inflated costs. It's a clear signal they're serious about protecting their bottom line and, the integrity of the system.
What else are they doing on the cost control front?
Expanding their value-based care portfolio, particularly in behavioral health and oncology. They said more than 1/3 of their benefit expense is now in downside risk arrangements.
So pushing providers to share the financial risk for outcomes. Right. More accountability.
Now, the Carelon platform got mentioned quite a bit on the call. How is that contributing to their strategy amidst all these challenges? It sounds like a growth area.
It definitely is. And Carelon's strong Q2 performance isn't just about, impressive revenue numbers. It really underscores Elevance's strategic pivot towards more diversified, value-based care services.
How so?
Well, CarelonRx, their pharmacy benefit manager, grew operating revenue over 20%. They're gaining traction with larger clients, scaling up their specialty pharmacy assets. This shows they're trying to capture more of the healthcare dollar within their own ecosystem, moving beyond just traditional insurance.
Right, integrating services.
Exactly. Profitability there was impacted a bit by growth initiatives as they expand, but Carelon Services, which includes things like home health and complex care management, delivered over 50% growth in revenue and operating gain.
50%. Wow. Yeah, through expanding risk-based relationships and integrating CareBridge. So this isn't just some side project. It seems to be a key part of their long-term growth story, strategically positioning them to manage complex patient populations and capture more of that overall healthcare spend.
Interesting. Okay, what about capital allocation? How are they managing their finances, share buybacks, debt?
Sure. Elevance Health ended the quarter with a debt-to-capital ratio of 40.8%, which is pretty standard for them. They returned about $2 billion to investors so far this year. That includes $380 million in share repurchases just in Q2.
Did they slow down the buybacks given the guidance cut?
They said they adjusted the pacing in Q2, to ensure flexibility, but they want to remain opportunistic. They view the stock as trading below its intrinsic value.
So they might buy more if the price stays low.
That's the suggestion. They anticipate lower M&A activity in 2025, so there's likely more room for opportunistic share repurchases. They're maintaining their long-term algorithm, roughly 50% of free cash flow to M&A or reinvestment, 50% back to shareholders.
And that 50% to shareholders is split how?
Usually around 30% for repurchases and 20% for dividends.
Okay. This all inevitably raises the question.
Sure.
What's the outlook for 2026? I know it's early, but what hints did they give?
They were careful, obviously, but they stated the actions they're taking now, the cost controls, the analytics, the value-based care expansion are designed to stabilize trends, improve pricing alignment, and restore operating leverage over time.
So they're laying the groundwork for recovery.
That's the plan. For ACA specifically, they've already repriced their products for 2025, reflecting the rising cost intensity. And they expect a broader market reset in 2026 if those enhanced ACA subsidies expire at the end of this year.
Right, the subsidy cliff. That would cause major shifts.
Huge shifts. Further risk pool changes. In Medicaid, they're proactively engaging with state partners, expecting a meaningful catch-up in rates eventually, as that utilization data becomes clearer and more actionable.
But lots of uncertainty remains.
Oh, definitely. Policy uncertainties are the biggest unknown. What happens with the ACA subsidies, the impact of the new market integrity rule, which, interestingly, they see as a net positive for them, and then potential new Medicaid work requirements or more frequent eligibility reviews in some states.
All things that could pressure enrollment or shift the risk pool again.
Exactly. Could lead to near-term enrollment pressures for the risk pool shifts, and one key assumption they made for the rest of this year, 2025.
Yeah.
They've assumed membership stability in ACA for now, but they anticipate a much more meaningful Q4 utilization surge if Congress lets those enhanced premium tax credits lapse at year-end.
The use it or lose it effect before costs go up.
Precisely. People scheduling elective care before their out-of-pocket costs potentially skyrocket in 2026. They expect this pattern to be even more pronounced than in prior years because of the higher underlying acuity in the pool now and the potential severity of that subsidy cliff.
Sounds like a potential game of musical chairs for patients trying to get care in before the music stops.
That's a good way to put it. A big variable for the end of the year.
Okay, so what does this all mean for you, the investor, grappling with this really evolving landscape? We've just deep dived into the complexities of Elevance Health's Q2. Now, let's shift to our This Is Not Financial Advice segment.
Right.
Where we pitch an outrageous but plausible trade idea, really designed to make you think differently about the insights we've just covered.
Okay. So considering these themes, market recalibration, rising acuity, that intense fight against aberrant billing, here's a thought. A paired trade.
Okay, intrigued. Let's hear it.
All right, bear with me here. For the short idea, consider going short a basket of, say, publicly traded, smaller, maybe less diversified healthcare service providers.
Okay, which ones specifically?
Think about those who primarily rely on high volume, maybe out-of-network services, the ones who might appear more vulnerable to aggressive coding tactics or look like they could be exploiting that IDR process.
Okay, what's the thesis there?
The thesis is, as the big payers like Elevance Health really intensify their payment integrity efforts, deploy more analytics, even pursue legal action, the profitability of these specific types of providers could face significant headwinds.
More so than the market expects.
Potentially, yes. Impacting their top and bottom lines more severely. We're seeing a really clear signal of payer pushback against what they see as excessive, maybe even abusive costs. So short those potentially vulnerable providers.
Okay, that's the short side. What's the long side of the pair?
Simultaneously go long Elevance Health.
Interesting. Even after the guidance cut.
Yeah, hear me out. While they've obviously taken a hit on guidance, look at what they're doing. They are proactively tackling these cost trends with technology, with legal action. They're repricing products. They're leaning into disciplined growth in high-performing areas like Carelon.
So the bet is they manage through this better than others.
The plausible bet, the idea, is that their decisive actions to stabilize margins, their operational discipline, will allow them to emerge stronger from this industry-wide recalibration. That could ultimately lead to margin recovery and outperformance relative to peers who might be more reactive or, like on the short side, more vulnerable.
So the market might be underestimating the long-term benefit of their aggressive stance on system integrity and cost control.
That's the thinking, playing both sides of that payer-provider tension.
As a bold idea, playing both offense and defense on this whole evolving healthcare landscape. Okay, always remember, everyone, this segment is purely for discussion, intellectual curiosity, definitely not financial advice.
Absolutely not. Just a thought experiment based on the earnings call.
And that wraps up our deep dive into Elevance Health's second quarter 2025 earnings call. We covered quite a lot. The revised outlook, the really granular details on ACA and Medicaid pressures, the strategic actions management's taking, and what these broader market dynamics could mean for their future.
Yeah, we hope this detailed breakdown gives you a clearer picture, helps you connect the dots on what's truly driving performance in this pretty dynamic sector right now.
It's complex stuff.
It really is. Remember, in a world just flooded with information, critical thinking, understanding the nuances, it's just paramount.
So we encourage you, listening, to reflect on what stood out to you from this. Were there any insights that surprised you? Any questions that this discussion brought to mind?
Thank you for joining us. We really hope you feel a bit better equipped to navigate the complexities of today's market after this.
Until next time, stay informed and keep thinking critically.